Defying predictions of recession, the US economy has grown faster than many other countries. Led by government fiscal expansion and higher consumer spending, the US economy appears to be the global economic dynamo. Government green subsidies led to a boom in construction and manufacturing investment. Yet, despite the seemingly impressive GDP statistics, some economists warn of an economy running on embers. Consumer debt is rising. Net saving is becoming negative as households burn through their pandemic savings. So is the economy finally heading for a hard landing? Or are there still reasons for optimism? A curious feature of the US is that despite seemingly good economic data, falling inflation rate, strong economic growth, rising employment, consumers report pessimism about the state of the economy. Now this has a certain partisan bias, with Republicans most likely to believe the US is in recession already. Now the US is definitely not in a recession, but at the same time things are not quite as rosy as they appear on the surface. US real median wages are rising, but really very slowly. They're barely above pre-pandemic levels. Income was boosted by one-off government stimulus checks during the pandemic, and this temporarily enabled higher savings. But since 2022, US consumers have been running through these savings to keep up with their spending. In a struggle to keep going, household saving is now reaching a record low level as consumers are stretched, burdened by higher prices, higher interest rates and higher rents. Now, one thing when looking at the American economy, it's always worth bearing in mind. There is in effect a two-speed American economy. There is the high-income homeowners, perhaps with a fixed-rate mortgage, and this group tends to have a high disposable income and large savings and wealth. But the other America is the America with relatively low income, paying very high rents, living paycheck to paycheck, and this group tends to have no real savings. And it's the group which has struggled from higher interest rates and higher rents. And this is really starting to take its toll, leading to a fall in consumer spending in April, which is quite a big turnaround. Big firms like McDonald's are warning that American consumers are holding back from spending. Now, since the credit crunch, the American mortgage market has shifted towards very long 30-year mortgage terms. This means that many homeowners are kind of insulated from the recent interest rate rises. However, the other America that relies on consumer credit, personal loans, credit cards, payday loans, they have been much more affected by rising interest rates, which is taking a bigger share of disposable income. And this is one reason why so many people feel worse off, because inflation doesn't take fully into account the higher interest rate costs. The US has seen a worrying rise in credit card delinquency rates as cost of living pressures bite. Now, the fall in inflation, although welcome, has not changed the fact that price levels have gone up significantly, especially for basic items like food and rent. In the past 2 years, the economy has seen pretty strong growth in employment levels, but the employment picture is starting to change quite quickly. Last March, employment growth was 50% lower than the previous month and below many people's predictions. Citi chief economist Andrew Hollinghurst, who rejected predictions of a recession last year, is now doubling down on his contrarian position by predicting a hard landing this year. He cites a weakening labour market and particular weakness among small firms who are often the first to notice any decline in economic activity. And more firms are starting to report more layoffs. Now, if real wage growth has been weak in America, where has the economic growth been coming from? Well, one answer is that the government has pursued an unprecedented fiscal expansion. The US Inflation Reduction Act of 2022 involved over $400 billion of government subsidies for green investment. Now, it was very effective in spurring a boom in construction, but the successful take-up meant that the federal deficit rose much faster than expected. It's now 7.4% of GDP, despite being at a stage of the economic cycle where you're supposed to be reducing it, not increasing it. And the deficit is forecast to keep rising in the coming years. As a result, US debt is slowly ticking up, to really near record levels. Now, on the one hand, you could say that the US has a large capacity to absorb more debt. There's a high global demand for buying US treasuries, at least for the time being. But still, there's a limit to how much you can boost economic activity by relying on government fiscal expansion. Now, another cloud on the horizon is the upcoming November election. A Trump victory could well mean a large tax cut, perhaps an escalation of the trade war with China and other countries. Now, tax cuts can boost spending in the short term, but with a federal deficit at 7.4% of GDP, the US economy really should be putting up taxes rather than more unfunded tax cuts. As I said before, there's a limit to how much you can prop up an economy through fiscal expansion and borrowing alone. Now, another reason for strong economic growth in the United States is relatively high levels of immigration. Whatever the political controversy, it has helped firms produce more. It's possibly led to wage restraint, helped perhaps lead to lower inflation. A sharp cut in immigration would lead to lower economic activity, especially amongst those firms reliant on cheap immigrant labour. Now, so far, the US has shrugged off its trade war with China. It's not really affected GDP. But a massive escalation of a trade war would create winners and losers and start to affect the overall economic picture. Now, also, so far, the US has kind of brushed off all the political turmoil. But the extreme polarisation we see in US politics does raise the prospect of institutional decay and institutional decline. For example, wrangling over the debt limit could be a major problem. And there's even a degree of uncertainty about the peaceful transfer of power, something usually taken for granted in America. Now, the final point is that in recent years, interest rates have gone up quite sharply. But because of the fixed rate mortgages, the negative effect has been less than many predicted. But interest rates will increasingly have an effect with a suitable time delay. They're significantly higher than 3 years ago, and firms, households, consumers will all be affected by keeping interest rates high. Nevertheless, despite these warning signs, there are reasons for optimism. Inflation did come down quicker than predicted, without the hard landing that some forecast. In fact, the 2023 recession was the most eagerly anticipated recession that never materialised. Also, despite some real weaknesses such as low savings, there's also some reasons for optimism. Productivity growth has outstripped other countries. Manufacturing investment has helped to see a welcome return of manufacturing jobs and increases the long-term capacity of the economy. Also, the baby boomer generation are retiring with record levels of assets. And this is really helping to maintain strong demand in the service sector. Because for all the political focus on manufacturing, it's the service sector which is the biggest component in the US economy. Also, whilst real wage growth has been pretty weak, profits soared during the pandemic, meaning that corporate America did much better. And in fact, this helps to explain why, despite all the good economic statistics, many Americans don't see it that way. This video looks at why many Americans feel poor in the world's richest country.